In our second vignette on investing tenets, we're going to review just how important it is to seek investments where competition is low. So if investing based on trends and news flow is your thing, to do it effectively in today's information age, you'll have to dedicate a significant amount of capital to building an infrastructure to stay one step ahead of everyone else. And furthermore, you're increasingly going to have to compete against robots. But for everyone else, it's important to go where the competition is low, just as Russell Crowe explained in A Beautiful Mind. Because everyone typically goes for the beautiful tall blonde amidst heavy competition, it's nearly impossible to close a barroom deal. Instead, Nash predicted all of his friends would be successful if they went for the overlooked girls in the group. Today, there are a lot of tall blondes in the market, as competition for growth investments has driven certain valuations to ridiculous levels. Take, for instance, Tesla. For the stock to earn a fair value north of $200 per share in the future, where it currently is, the company will need to sell more cars than BMW currently sells this year. Yet, even under the rosiest predictions, BMW will outsell Tesla 40-1 this year. Elon Musk clearly has some lofty expectations to live up to.
Take that off. What are you?
Genius, billionaire, playboy, philanthropist.
Investors have exhibited similar types of behavior when it comes to picking funds to invest in. Take, for example, the best performing mutual fund of the last decade, the CGM Focus Fund, which generated a torrid 18% a year, significantly outperforming the declining market and its closest peers. Yet, ever since it was crowned the best performing fund of the decade, it has underperformed the robotized index fund by 50%. What is even more surprising is that over the same record-breaking decade, instead of enjoying an 18% compounded return, the average investor lost 11% annually as they knee-jerk reacted to fantastic years, which were then followed by underperforming years. What makes this beauty contest-like behavior so peculiar is that individual investors actually know that great results in investing require them to swim against the school. In a 2001 article published in the Journal of Psychology and Financial Markets, 71% of investors surveyed viewed a drop of 20% in the Dow as a great time to buy, while only 9% thought it was a good time to sell. This is one of the reasons why transparency into holdings and investor education is really important, especially for contrarian strategies like ours, which often buy underperforming assets, as this underperformance almost never corrects immediately. Take Europe, for example. It's underperformed global markets for the last 15 years. The ECB has recently started its own QE program, which has caused significant euro weakness. This is going to go a long way to helping exporting companies in Europe, above and beyond the green shoots starting to emerge from the region. Some of the pronounced underperformance has already started to correct, but unsurprisingly, global investors' exposure to Europe was near all-time lows before this rally began. The underperformance of Italy has been even more pronounced over the last 15 years, underperforming global markets by 65%. And while we would never go out and buy the index outright, there are numerous companies that don't require any beer goggles to find attraction to. Italy is filled with a few beauties, and the bars have very little competition right now. Many investor relations departments we know in Italy feel like Maytag repairman given the phone no longer rings. Global investors consistently focus on the tall blondes. This truism extends not just to managers and markets, but also industries. Displaying the S&P 500's annual returns by industry, one can see the checkerboard-like nature of the under and overperformance, which confirms that underperforming industries frequently turn into outperforming industries in the ensuing years, and vice versa. Rare are the long-term outperformances, and the bigger the outperformance, such as technology stocks in the late 90s, the bigger the subsequent underperformance. One industry investors have stood up on the dance floor is the auto industry, where we have large positions in Fiat Chrysler and Renault. We like these companies for very unique reasons, but the industry has provided a great place to hunt for value. We've analyzed trading in all of the major OEMs over the past 15 years, and while investors have traditionally given these companies nearly a 14 times earnings multiple, which is also cheaper than the overall market, the industry currently trades for less than 10 times earnings. That has left a gap of over $350 billion in market capitalizations of the industry. So that means as valuations normalize in the industry, a few of these girls will be inheriting a fortune. While some of our flirtations have started bearing fruit since 2015, we've picked investments in industries and markets that have underperformed significantly over recent years. Thanks to good managers at these companies, making sure the assets are being used most effectively, The low competition may just help us get lucky.